All right, can you hear me now? Okay, perfect. Thank you, Julie. I appreciate that. It's our first time doing this from a tech perspective, so we're still trying to get her figured out. Thank you for the patience. But anyway, we're going to go ahead and get moving here. My name is Adam Boatsman. I'm the managing partner of BGW, and we're going to be talking about year-end tax planning today and some of the common mistakes that we see people make over and over again. For some of you guys, you've heard this before. For other people, this will be a refresh, of information you might have heard before. For other people, this is going to be brand new. So we're trying to tailor this to all audiences, and we hope that you guys get something out of it. So let's go ahead and get started. And again, if you've got any questions, please feel free to hit us up in the chat, and we will try to get them addressed as we go. And we'll save some time for Q&A at the end. But I always like to start off with a little bit of jokes about tax day. And one of my favorite ones is tax day is the one day of the year that I disappoint the government as much as it disappoints me. That's what we're always trying to do is try to minimize our tax liabilities as much as possible and stick to the man. But anyway, what we're going to be talking about today are really four different strategies that we've seen people make mistakes on time and time again when it comes to tax planning. We recognize the year is over. So, it's December 17th. So a lot of people may be thinking, well, what else could I possibly be doing, at this time of the year that could actually make a difference? The answer to that is actually a lot, even, by the end of the year, but also potentially changes that I can make right after the year that are sort of fundamental in terms of what you're going to pay yourself or what you're going to pay in taxes. So the real big four strategies that we're going to talk about in this webinar are, owner fringe benefits, expense reimbursements, how to pay yourself correctly as a business owner, accounting method changes that you can make that'll impact the way that you pay taxes, and then also what kind of entity you are. So the first one we're going to hit is owner fringe benefits. So, if you guys are fans of the book Rich Dad, Poor Dad and Robert Kiyosaki, who cares about the myths of did he really make the money or not? The fundamental principle, or if there really was a rich dad, that really doesn't matter. The fundamental principle of what he was preaching was, hey, is there stuff that I'm paying out there that I'm paying for post-tax that I'd love to get a tax deduction for, that I can make a case for ordinary and necessary reimbursement of business expenses. So in other words, they're ordinary and necessary for the IRS. They may not be ordinary and necessary if someone was to buy my business, but they're ordinary and necessary for me as the owner of this business in terms of what I'm doing on a day-to-day to run this place. So, and the IRS allows these. The thing that I always find funny about owner fringe benefits is the conversation about owner fringe benefits always starts the same. It's kind of like either A, hey, what else can I be deducting that I'm not deducting? I want to be aggressive. I want to be in the gray area. I want to go up to the line, but I don't want to cross the line. That's one flavor. Another flavor is people feel shame and guilt. I don't really know. Should I be deducting that or not? Or my CPA told me that I couldn't do that. It was an IRS red flag. That's the other flavor. Here's the funny punchline. If you Google IRS fringe benefits, you'll actually see the IRS publication that tells you exactly what fringe benefits are allowable. That's the whole punchline here. Is like a lot of times I've heard people say, my CPA doesn't told me that I couldn't do this. And then I pull up the publication that the IRS says that, hey, these are all allowable. And I say, well, it says right there that this is allowable. But generally speaking, for a business owner, that's really going to come in the category of, an auto, my home office, hey, do I have, a second home that I could perhaps rent for myself for a business purpose? Every owner, every business has to have an annual meeting. Could I perhaps have that annual meeting, pull double duty with a vacation, on the back end of it? Because, if you think about it, a lot of large companies have nice meetings in exotic locations. There's no IRS rule that says, well, that's only reserved for Fortune 500 companies. That's not reserved for companies like BGW. You need to be going to the Motel 8. You're too little. So anyway, those are generally the categories of owner fringe benefits. I put down executive assistant right now in this too, because a lot of people always ask, hey, I'm working, my spouse is working, we have a nanny, can we deduct the nanny? And the answer is, well, no, because well, you could if you offer childcare to everybody, but at the same time, what's your nanny really doing? Well, it turns out what the nanny's really doing is more the things that an executive assistant does. And on the side, there also happens to be some light childcare. So, I think the way that I always look at this is, the sky is the limit in terms of anything that we can make a case for. Let's just make a case that's going to stand up. And, absent some really egregious, things, most everything is going to stand up that I found that people want to deduct. Now, what I can't do, for example, would be I'm a single owner company, no related parties, work in the company. Can I deduct 5 cars? You could try that, but I wouldn't advise it. However, if you had your car in the business, plus you had a Turo business on the side that's the owner car business, then maybe you could deduct your 5 cars as long as the cars are posted on Turo. So when you get that, you're like, oh my gosh, it's the greatest thing that I've ever heard. You know, I haven't been deducting these things. What should I do? Well, the good news is you could go backwards in time, and basically treat these as expense reimbursements back to yourself and make yourself whole. And, all's not lost. Go ahead and get the deduction for stuff that you weren't deducting in the past. What's typically the right time frame to look back? If you think about it, well, where does the IRS talk about how far back we can go? Typically, if I can get a refund going back 3 years and the IRS general statute of limitation is 3 years, that would seem to believe that going backwards 3 years in time is a reasonable time frame that I could go back. Not saying that I have to amend the tax returns, but that's a reasonable time frame that I could go back in time and bring my expenses forward to make myself whole. When I'm ready. So then, kind of the next thing that we always hear about is, what should I pay myself? And common occurrence that we find, like we rarely find people that are paying themselves too little. More often than not, we see people paying themselves too much. And you might be thinking to yourself right now, well, wait a second. Somebody told me, at some point, that I have to take a reasonable wage as the business owner. That's correct. The tax code actually does say you have to take a reasonable wage, but there's no actual definition of what that reasonable wage is. And the problem that you run into when you're talking about salary versus just taking money out of a business in the form of a dividend or a distribution, depending on the type of the entity that you are, is that everything that's subjected to a salary is not only subjected to a higher tax rate, it's also subjected to Social Security taxes. And if it's high enough, the Medicare surtax. So that's effectively all in about a 45 to 50% tax rate when you layer on state taxes to take $1 out via a paycheck versus if I take $1 out in a distribution or a dividend, it's more like a 35% kind of worst case scenario tax rate. And that's permanent. Like that's not timing difference. That's permanent savings. But at the same time, we still want to follow the law. So what this slide really represents is the order of preference in terms of, which direction should I go in terms of taking the wage? I start off with nothing, and when would I say take no wage? Well, if I own a company and I'm taking $100 salary, but the company lost 50 grand, then it's pretty easy to make the argument that $50,000 of my $100,000 salary created the loss. So I wasn't really taking, I wasn't really taking wages or paying tax at that point anyway. I was just creating a loss, that I had to fund somehow. So first off, if you're not making any money, you should not be paying yourself. Like I've never had that come up in 20 years of doing this. I've never have that come up on an audit where somebody lost money, they've got no owner salary, and the IRS says, "Hey, wait a minute. The owner didn't take enough salary there. I need you to take more salary and make this guy lose more money, please." That's never happened in my 20 years of doing this. So once you clear that hurdle, then you start getting into, well, what's the right salary to take? And this is where sort of the gray area exists. And the IRS, term for this really is the lowest defensible value. And what does that mean? Let's use the same scenario of the guy that's making, I use guy in a gender neutral format, by the way. No offense to the ladies out there, but the lowest defensible value is really, the lowest amount that the IRS will let me get away with. So using the same $100 scenario, what that represents, if you just look at, well, what are tax court cases? What tax court cases would say that if I made $100 before taking a wage, anywhere between 30% and 50% should be a wage. Now, nobody's ever gone to tax court and said I made too much money. All that case law is really predicated on people who took below 30%, and the IRS was trying to argue for a higher number. Where the case is settled at was anywhere between 30 and 50%. Are there some cases that were higher? Yeah, were there a couple cases that were lower? But if you kind of look at, what's the middle of the bell-shaped curve? 30 to 50%. So, usually in my world, so in that scenario, you take, $30 or $50 as a W-2, and you'd have, $70 or $50 as a dividend. The tax savings on that would be, the Social Security taxes on the dividend or the distribution. Now, a lot of people that are C corporations might be asking themselves, yeah, but don't I need to take profit down to zero? I don't want to be double taxed. It's true that C corporations, pay an income tax, and then if I want to take cash out of a C corporation, I have to pay a dividend tax on top of that. So if a dollar of profit is made and that same dollar is going to come back out, it actually is more efficient to go the W-2 route. But the thing is, and take profit down to zero in the C corporation. But the thing is, very, very, very rarely does a C corporation actually distribute 100% of its profits in the form of cash. The reality is most C corporations are retaining some cash for future growth or paying down debt or whatever, so that there's always some amount of cash that just can't be distributed. So if you think about that from that perspective, then in a C corporation still taking a dividend, even though it's technically double taxed, if you look in that specific year, the tax rate is actually lower than had you gone the W-2 route in its entirety. So even though if you'd taken the whole dollar out, it might have been a higher tax rate, you're not taking the whole dollar out. You're actually only taking about 50, 60 cents out. And when you combine those tax rates together between W-2 and dividend, it's always cheaper to take more in a dividend than it is the W-2. So, the next area you want to get to is lowest defensible value. So then when you get into, okay, well, I'm beyond that, what's the next here? It's really the maximum amount to fund your retirement, which depending on the nature of your retirement plan is going to be anywhere between around $250,000 up to about $400,000. It's going to be, again, dependent upon your age and the nature of the plan. But that's really the max that you ever need to take. I've never had any audit come up where the IRS says, no, I need you to take more than that. And if you kind of look at the defensible argument behind that, well, if you look at publicly traded C corporations for certain employees like the CEO, they can't even deduct more than $1 million. So even though Elon Musk makes more than $1 million, Tesla can't deduct it. So clearly the IRS has already taken a position on the maximum allowable compensation is 1 million. So like you've already got a ceiling of 1 million. But then when you start looking at, well, but I'm not a publicly traded company, it would make sense that I would pay myself a lot less. So then you get into argument number two, which is, if I were to replace myself, what would I pay my replacement? It's not, a $2 million salary. Um, you go to Mercer or somebody like that, Robert Half, and do a compensation study. You go to a recruiter, they would tell you what you need to pay. But the punchline is, it's always going to be in that strike zone that I just gave you between Social Security and about $400,000, or the Social Security limit, which is around $170,000 today, and the $400,000 is always going to be the range for most of your executive levels, including the CEO. If private equity was going to replace you, that's the amount that they're going to impute on your replacement value. So you're always going to be safe in that range. Any dollar more that you pay yourself, you're leaving money on the table. So when I get to the next question, accounting method changes. This is one where we see people create a lot of messes for themselves. So with accounting method changes, you know, the the first one that everybody's really aware of is, if I'm an accrual basis taxpayer, meaning like, the easiest way to understand that is, whatever my bottom line profit is, and I'm keeping track of receivables, I'm keeping track of payables, whatever my bottom line profit is, that's what I'm paying taxes on. That's the accrual basis taxpayer. Versus the cash basis taxpayer is, whatever cash I receive, that's what I'm paying taxes on. And whatever bills I pay, that's what I'm getting a deduction for. When you're growing, or alternatively, you don't have a big customer deposit scenario. When I'm talking big, I'm talking like software company that gets all the renewals in advance a year up front. That would be like a big number. The occasional customer deposit wouldn't really be enough to move the needle. So it'd be big numbers. The question is, should I be an accrual basis taxpayer or a cash basis taxpayer? Oftentimes, the cash basis is going to be the right answer for you. And a lot of people on the call right now might be thinking, well, duh, I knew that, Adam. Thank you very much. But what a lot of people didn't know that we see a lot of times is that in 2017, you think it's been out there since 2017. Everybody know about this, but they don't. The IRS raised the limit on who could be a cash basis taxpayer. Almost tripling it. Secondly, if you trip the threshold, it's based on an average look back period. So even in the year that you trip it, you still got an average of a few years to finally have tripped it in the eyes of the IRS. And even then, once you do trip it, by all circumstances, you've got a 5-year window to pick back up the difference in terms of the additional tax associated with the flip. So it's a great deferral mechanism that's available to people because, eventually do you have to pay the piper? Yeah, but you can basically defer out paying the piper years. So we do see a lot of new clients that come on board with this that, for whatever reason, they didn't get the memo that the limit that would allow them to be a cash basis taxpayer went up. A lot of service-based companies too, like CPA firms, law firms, medical practices don't realize that exception, of the gross receipts test doesn't even apply to them. So for them, it's unlimited. But someone told them somewhere in the past that there was a limit. So that's one. The second is, inventory. What a lot of other people also didn't realize is that when it comes to inventory, subject to the same gross receipts test, if I have inventory, is that, first off, I can have a de minimis inventory amount. So, typical company that has inventory, especially if it's kind of big parts, they've got the HVAC system itself but then they have all the little repair spares, if I'm an HVAC contractor keeping inventory. Well, I can't do anything about the HVAC system, but the spares and the maintenance parts, I can declare de minimis value and then automatically deduct all those spares, which if you think about it, well, they're just spares. How big are they? If you add up all those spares, oftentimes that can be hundreds of thousands of dollars of a deduction that I can accelerate and go ahead and expense through my cost of goods sold for tax purposes. That's one item. The second piece that people didn't really realize either, again, subject to the same gross receipts test, is if I really am a manufacturer, um, I also can elect to expense the labor that went into my cost of goods sold instead of capitalizing it in inventory, which is what I had to do in the past. So again, typical manufacturer, labor is typically going to be about half of the cost of the inventory held at cost. So that's another great deduction that you can accelerate that we just don't see people taking advantage of a lot when they become new clients of BGW. And then really the last one, a lot of people have heard, a lot of people have heard about accelerated depreciation. What a lot of people don't know is that on residential and commercial properties, residential meaning I'm treating it commercially, but it's still a residential structure, is you have the ability to carve out the structure into separate components that qualify for all the same accelerated depreciation methods as do automobiles and pieces of equipment and stuff like that. So if you think, roof, HVAC system, parking lot, landscaping, all that kind of stuff, when you add all that up, oftentimes that's about 25% of the cost of a piece of real estate. All that qualifies for accelerated depreciation methods. And again, it's shocking how many clients come in and, they've got a commercial building and, what we see is just straight line, 39 years. But you have the opportunity to make that up if you haven't been doing it in the past. So the next thing that we're going to touch on that, again, we see people screw up a lot is what kind of entity should I be? And, a lot of times when people form, they've got this question, but at the same time, when they're already established, it may be that they're not the right entity. So just generically, I didn't put it on a slide, but when we get asked the question at BGW, what entity should I be? Our default response rate, this response is always set up as an LLC for state, always consult with an attorney. But this is what attorneys typically say too. Always establish as an LLC, and then we may elect to do something later. But if you start there, you can always change later without a whole lot of pain and suffering. But once you're something else, like a C corporation, an S corporation, it's very difficult to revert to something else. So LLC gives you the maximum flexibility to it's almost like the chameleon. If you're an LLC, you can change shape shift in anything you want to be, but an S corp can't be an LLC. Like you can't like an S corp, like a true S corporation, can't convert over to an LLC easily. It has to become a C corporation. So we always say start with an LLC, but absent that, what we see a lot of times is people have their Schedule C. So they may be an LLC, but they're a single owner. So what they're doing is they're actually filling out what's called a Schedule C on their personal income tax return. There's no separate company tax return. That works really well when you're smaller. But the problem that you get with that is that similar to partnership, all the income is subject to Social Security taxes. So it's the equivalent of all the money is the same as W-2, from a taxation standpoint, with the limited exception that you do qualify for the qualified business income deduction, which is awesome. But, at about the $50,000 in profit mark, you trip the switch to where, hey, if you were an S corporation, there actually would be some payroll tax savings in here. So, the first mistake that we make is, hey, should I be going from a Schedule C to an S corporation? And again, you may be listening, I already knew that. I was like, it's shocking how many 20, 30, $40 million companies that we see making tens of millions of dollars that are still Schedule C's on the owner's return when they come to BGW. It's not technically malpractice, but I get the vomit up in my stomach. And there's nothing I can do about that in terms of going backwards. All I can do is go forward. So, that's sort of item number one. If you're in that category and it's already 12/31 or 12/17/2025, you could elect to do something today, but the IRS recognizes that we're all a bunch of bozos and we forget to do this from time to time. So there's actually an automated approval process with the IRS that if you're late, you can go ahead and elect S status late, should be automatic approval, makes it retroactive for all of 2025. The key thing is you want to get that done before March 15th so that you can extend the tax return as an S corporation. Otherwise, can you still do it after that? Yeah, but it oftentimes creates a lot of notices and some hassle to get it done. So that's the first big mistake that we make. The second mistake that we see, which is I'll switch to the end here, the LLC. So listen to your advice, Adam. It's great. I'm an LLC. I've got a couple partners. I don't plan on selling anytime soon, and I'm not I'm a doctor and attorney. I wouldn't necessarily qualify for any sort of capital gain event, which I'm going to talk about next. Should I be an S corporation? Yeah, we see that mistake a lot too, in terms of LLC taxes an S corporation would be the best option. Again, it's actually really the same economics as a Schedule C. It's just the LLC, it's going to be more relevant if it's a multi-owner environment. If each owner is making over 50 grand, then it's going to start making sense to elect S status. So then the last entity classification problem that we see is, the decision of should I actually be a C corporation, which is a little more rare and people are just starting to learn more about, but it's actually been around for a while. So, for a long time now, and they actually just made the rules around this even more attractive as part of the One Big Beautiful Bill Act. But for a long time now, subject to some certain restrictions, which, most companies that would be BGW clients would qualify for. If you were a C corporation and you'd been the owner of that C corporation and you were the original stock owner, that doesn't mean you have to be a founder. It just means that you were the original owner of the stock certificate that you have. Then after 5 years of holding that stock, you can sell the stock and up to $10 million of the gain would be tax-free. If you happen to be married and your spouse also owns stock, your spouse also had 10 million. So if you're married, 10 million becomes 20 million. You got kids, 2 kids, it becomes 40 million. So it's a massive, massive game-changing benefit for people that are considering selling their companies. But the problem is you actually have to be a C corporation, and that involves some structural changes. So my point of bringing it up on this webinar is you may be doing everything else right that we just talked about, but if you've got an inkling that you're thinking about selling your company, in the next 5 years or, right beyond 5 years, it would behoove you to at least make the evaluation now, should I be a C corporation or not? And what are the consequences associated with that? Because the starting period of your 5-year clock, which with the One Big Beautiful Bill Act, there is a phase in now to where 3 years is kind of the first phase in period where you at least get part of the gain exclusion. But if you want to start the clock as early as possible. So that's why, I put it in this presentation about, hey, mistakes people make before the end of the year. It's that, look, if I miss another year, like that's another year that I got to hang on to this company that I could have otherwise been converted and had a stock sale. So not being a C corporation when I really should have been a C corporation based on when I'm having a liquidity event is another big boo-boo that we see fairly frequently. So as I'm wrapping this thing up, and I appreciate you guys' time, this is always one of my favorite statements when it comes to taxes. So let me get this straight. I'm paying taxes on my wages, then paying sales tax to spend my own money, then paying income tax on money that was already taxed. Then when I die, my kids pay the death tax on money that was already taxed. Yes, that is in fact how it works, which is pretty ridiculous. It's funny when you think about this. Most people think about their tax rate just in terms of their federal and state income tax, but when you add in the sales tax and the property tax, most people pay about 15% more tax than they actually think that they're paying based on that. So our job, as an accounting firm is to help you make that as low as possible. I can't do a whole lot about the sales tax and property tax, but I can do a lot about the income tax. Thus concludes our in-flight presentation. I do hope you guys enjoyed this and got some value out of it. And, now that we're at the end, I'm happy to open it up for any questions that you guys may have. Julia, thank you. I appreciate that. Any questions out there from our audience? All right, well, that's awesome. We're going to do some more of these. We're going to figure out the tech. Hopefully, if you're getting to listen to this from a LinkedIn posting that we'll do later, we apologize we couldn't do the LinkedIn event, and we look forward to hearing from you guys. Thank you very much.